Today, the state of the economy in around 10 slides. Hello again, it's Martin North from Digital Finance Analytics, one of the latest posts covering finance and problem news with a distinctively Australian flavour. Today I want to go through some of the most recent data and underscore some of the critical assumptions about the economy, the way it's working, and what might be ahead. And by the way, I will not be referring directly to a certain virus because if I do, I get demonetised. So I apologise for the circumlocution, which you'll see from time to time in this post. So let's get started. In a way, we've got a baseline view now because of the latest data up to the end of last year, which we'll touch on, and then some early glimpses of January, which effectively are beginning now to be influenced by the bushfires. And potentially now that gives us a baseline off which we've got to then think about what happens if the V thing happens. Right? So that's how I think about it. So it's important to understand where the economy was before the latest issues come over the top. And then perhaps towards the end, we can speculate a little bit about what some of those forward-leading indicators may be as to where the economy could get to move to over the next 6 to 12 months. Data to the end of December was actually better than people expected. So people were thinking 0.2, 0.3. It came out at 0.5% GDP. And that essentially was interesting because there was both output was a little bit sluggish, imports and exports were both a little bit down. But the real issue here is that consumer spending, again, was very slow relative to what we've seen previously. It was down from 2% to 1.2%. And we also know that new business contracted and, there's a bunch of things going on. So in other words, it wasn't too bad, but the other point there is that the output per capita was 0.7%. Again, that's quite low. And so if you start looking at per capita data, 0.2, it's pretty low. So in other words, our baseline economy is ticking along pretty modestly. But now, of course, Treasury is saying, well, thinking about what's happening at the moment, they're taking, maybe half a percentage point off GDP and also another 0.2% for the bushfires, so the chances are that the next quarter or two could be negative. The latest indicators of household confidence are looking pretty bad too, so people are worried, a lot of uncertainty, and I'm also seeing some of the leading indicators relating to intention to buy property now falling off. So in other words, the property support mechanism that we have in Australia may also be on the blink too. So this is the latest data to the end of January. And again, it's surprised on the upside, 5.2. In fact, they restated the previous month slightly higher. But what's interesting is that imports and exports both moved down, right? So imports were hit by fuel and capital goods. Exports dropped by 1.2 billion. And there were significant declines in metal ores and in gold. And remember that this is predominantly before the latest events, right? So what we're actually seeing is that we're starting, as we move from January onwards, with a reasonable trade position. But it's really important to understand how that trade position is built up. And if we go to the next slide, you can see that we can look at China specifically. And what's fascinating about that is that the export goods to China are around 12.5 billion a month. And it accounts for 38.5% of total export goods. And there's also services on top of that, right? And that includes education and, some other things there too. So you can see how reliant Australia is on the connection to China. And as you know, the Chinese economy has been slowing recently. And as a result of that, you've got to assume that some of that over the next 2 to 3 months is at risk. We don't know how much yet. But I think that's quite an important perspective. So we are highly leveraged to China. 38.5% of total goods exports is to China, and that is at risk. There is definitely a slowdown. You can look at pollution levels; they're way down. You can look at some of the other metrics of movements, people movements and goods movements, and they're all down. What's interesting though is that the Shanghai Stock Index, which went down initially, is now running up. Right, and that's because the traders there are thinking that China's past the worst of it. Now, whether that's true or not, who knows? But, even if that is true, the economic impacts of the turning off of the manufacturing systems across a lot of China is going to go on for months and months. The supply chain's already been disrupted. So you can expect to see the GDP number from China to Australia down. How much and for how long is still uncertain. They've certainly done some intervention. They've taken some of the rates down, and they're talking about selective stimulus if they need to do it. And look, all the central banks around the world, of course, came out and said, yeah, we'll do whatever it takes, right? But as we'll perhaps touch on later, that may stimulate some parts of the economy, but it doesn't cure anything medically speaking. If you look at the GDP numbers, that the consumer sector is very, very weak. Business investment is very, very weak. One of the reasons why the GDP number was quite good was because of significant government investment, and that's infrastructure investment, right? Perhaps around 25% of the economy is now being supported by government investment, and that's a big number. And if you look at the breakdown of the GDP, consumption's down. Housing is still down despite the little peak in prices recently. Exports, well, they helped a bit, but not as much. Imports, also potentially supporting a little bit. But actually, this is all about the fact, and it's not what people really fully understand, is the reason the economy is where it is and not worse is simply because the government is actually throwing a whole bunch of money through the investment channel. But the thing about the investment channel is that it takes a long time for that to flow through. So if you decide to sort of invest in road building, for example, right, there's a whole process before you actually start seeing the value come through. And my perspective now is that the government should have and needs to do something much more direct to support the economy. We can't just go through the investment channel because that takes too long. We need to find ways of actually supporting the economy more directly. And I'm particularly concerned about the small business sector because my small business surveys show that more than half of small businesses are now in cash flow issues, directly related to the bushfires and related to some of the upcoming medical issues that are around at the moment, right? Put that all together and essentially, whilst you can throw money at the, forward investments, it's not going to help them. So for me, the government's late to the party. They need to do some stuff and quickly. And I think it's true also that the so-called surplus is now just a dream, that we're never going to see that. We're never going to see a balanced budget. They need to do quite a lot more. And it's interesting that now Labour's come out and said, yeah, we'd support that if they did stuff. So I wouldn't be surprised to see some announcements very soon. But I worry that it's going to be not enough, not quickly enough, and not at sectors of the economy that can, pick it up quickly. I still think New Start should be an area where they should immediately lift New Start because that will put money into the economy and that will perhaps get people to spend. The other point, of course, is that if people are worried about going out and if people are worried about, what's going on, they're not going to spend that much anyway. So even if you gave them money, the question is, would that actually make a difference? And that's the other factor to bear in mind. But I think the small business sector is where some of the focus needs to be, and now. Small businesses, for me, are really where the sharp end of the pain is, right? And again, my surveys are saying that there are more small businesses struggling with cash flow, more small businesses thinking about laying people off or reducing hours. And that has a flow-on effect. There are more than 3 million small businesses across Australia employing more than 5 million Australians, right? Now, if they start having to lay people off or paying less wages or, frankly, shutting down, we're seeing businesses going, falling over left, right and centre. This cascading effect could have the most significant effects in terms of downward momentum on the GDP and on the overall economy. If you look at real inflation-adjusted wages, we've seen a structural change. It's a lot weaker than it was. And, in a time of uncertainty, households probably will save more rather than spend more. But households are definitely feeling the pressure in terms of the income growth is just not there in real terms, despite the fact that the cost of living are rising very fast. And by the way, although the mortgage rates might be a little lower, it's not enough to offset all of the other pressures. So yeah, this is probably one of my leading indicators is what's happening to wages, because this is really telling us the full story here. Australia is in trouble because effectively, although our wages relative to international benchmarks are quite high, there's been no growth for a very long time, and now effectively it looks like it could be going backwards. The mortgage stress data is showing a further rise. And, whilst there are some people who've got lower mortgage rates, and that's good because the rates have come down and their repayments are a bit lower, the fact is that the rest of the household budget is under severe pressure because of increased costs in other directions and the fact that wages aren't going up. So more than 1 million in mortgage stress. I'm also worried now Tasmania's got the highest proportion of households in mortgage stress, and that's a combination of the very high house prices in parts of Tasmania, but also the very weak income growth there. It's a wicked problem because basically you've got house prices rising very fast, but a lot of people are not seeing the income. So the income multiples in Tasmania are some of the most adverse now in the country. We've also got large numbers of people in Western Australia who are now struggling because they've been in very negative territory for a long, long time, and that starts to then translate into defaults. But we're also now starting to see pressure in some of the other big states as well, in particularly in New South Wales and Victoria, particularly in the urban fringe and to, for example, the west of Sydney, where we've got these large estates, people bought with big mortgages, very small plots, but their wages aren't catching up with their costs and therefore stress is right. This is a real important thing to watch. And I unfortunately think that we're going to see stress rising ahead. So this is the latest PMI and this the Purchase Management Index for Australia. And basically it shows that there's a lot of weakness. And, this is before the real impact of, the medical issues that are now coming up. This is partly being hit by bushfires. But what it shows is that businesses are really unable and unwilling to invest at the moment. So this is a big and important issue for us. Well, the question is, what are the things that businesses could do to turn this around? Basically, they've got disrupted supply chains, so many businesses are unable to get the goods and services that they need to be able to do what they want to do. They're also finding that their customers are also wrestling now with issues. So effectively, many businesses are really on the back foot. And remember that they've got cash flow. So businesses, particularly smaller businesses, actually have real cash flow issues because, if money is slowing on the input side and they've still got to spend on the output side, they get into difficulty quickly. And so expect to see cash flow issues for many businesses ahead, and that's why I think PMI will stay weak for some time. And by the way, one of the really interesting areas is the construction sector, because there a lot of the raw materials came from China. And I've had in the last week 5 or 6 messages from people in the construction area saying we are out of particular products. For example, some types of boards and some type. So basically that puts construction now into the slow lane. And they're looking at probably a delay of 6 to 8 to 12 weeks before it comes back on stream again. And that's a big, big issue. So I always warn about the building approvals data because the latest data which came out recently showed a significant fall. And the problem there is that the seasonally adjusted numbers move around a lot because, if you have one big high-rise approval, then that's a large number of units. So that's why it's very, very variable. But what we're actually seeing is continued weakness across building approvals. Again, not surprising. That's what I expected. And so the overall message from the construction sector was, we're seeing a massive turnaround and everything's fine again now. No, the data is actually showing pretty weak, and we're going to see more weakness ahead, I think, as the broader economy begins to slow as well. So this is another, I think, important indicator of what's going on. So the latest data from the RBA, which came out a couple of weeks ago, showed a little bit of movement, but not a lot of movement. The total housing credits at 3.1, which is pretty much at the bottom. It's moved up just very slightly. It was at 3 last time. But within that, it's all about unoccupied housing, particularly first-time buyers. Investment lending is still lower than it was a year ago. But personal credit is still lower than it was, but it's sort of going sideways a bit now. And in fact, the latest data from the last couple of months is indicating a little bit of a reduction in fall. In other words, some people are now having to reach for credit to be able to deal with some of the issues that they have. So overall, the credit numbers aren't looking very good. And by the way, business at 2.8% is also pretty weak too. And it goes back to what we said about the business sector being very weak. Therefore, they're unable to borrow. And so all of those factors suggest that whilst there are little bits of glimpses of good news in areas for some people, particularly around housing, the truth about credit is that it's definitely very slow. I don't expect to see much growth ahead. Well, one of the things I see from my small business services in particular is that they're having difficulty extending their credit. So effectively, banks at the moment are very tough on increasing overdrafts. And interesting, there was a IMF report that came out today which said that one of the big issues that Australia has is lending by banks to the small business and medium business sector are actually not doing what they need to do. So we know that many businesses are finding it really tough to be able to get sufficient credit to be able to see them through. Now, it may well be that the government does something to support that, or maybe they speak to the banks and the banks are a little bit more flexible. But at the moment, the bottom end of credit availability for a lot of businesses, more than 1 million businesses, is not where it needs to be. If you're a larger business, if you've got other assets, or if you've got a credit rating, those sort of things, you can still get credit. But it's the smaller, medium business. And I don't see much evidence yet that the banks are really willing to change their lending criteria. And it's interesting because the IMF report said, well, what should happen is there should be a tilting away from banks lending for mortgages to lending towards the business sector. And I said, well, better late than never. But of course, the problem there is that the credit risk ratings are so skewed because of the Basel ratings ratios. It's much easier and more economic for banks to lend for mortgages. The risks are lower too, relative to the business community. So my view is that the banking system itself and the Basel rules have actually created this problem, and the banks are just following, that rule. So unless we see some changes there, many businesses will not be able to get the credit they need to see them through. This is the APRA data. Now, APRA has been messing around with this data, so it's not totally right. But I just wanted to highlight how different banks are. So this is looking at the movements of owner-occupied and investment loans over the last month, right? And you can see that CBA and Macquarie is where all the growth is. Some of the other banks, particularly NatWest and Westpac, they're actually down on their investment loans. But I also know from talking to some banks that this data is not accurately reflecting the reality for many banks' internal portfolios. So there's some translations going on between the data that the banks are putting in and what APRA is reporting. And that's one of the issues now I think we've got, where in fact we're not sure whether this data is actually telling us the full story or not. So APRA needs to explain precisely why it is that there's a gap between what the banks are actually recording internally and what APRA is reporting to the public. I think some of the fudging relates to the one-to-many loan issue. So in other words, households will have multiple mortgages and APRA is reporting everything at the loan level. But the other is that the combination of movements between owner-occupied and investment loans appears to be different inside the record keeping within the banks and what APRA is actually reporting at the moment. So, there's one organisation that I was talking to that said, well, actually, APRA is saying that our investment loan portfolio grew this last month. Actually, it didn't. But because of the way that APRA is now choosing to define loans, they're actually putting some of our owner-occupied loans into the investment bucket. So there's some really funny things going on. So I'm not sure that I can trust these numbers. Well, now, the latest core logic data show significant rises in home prices. I have to tell you that some of the other metrics that are coming out from other organisations are not as strong as the core logic ones. So that's the first thing to say. And specifically, we know that movements are actually isolated to some particular postcodes. But nevertheless, there's been a bit of an uptick, particularly more affluent household postcodes, so particularly larger property values. So that's part of the story. But yeah, the question now is what's going to happen? Because we know that the leading indicators in terms of intention to transact has dropped off over the last 2 or 3 weeks. We also know that the auction clearance rates were pretty strong over the last few weeks. So it'll be very interesting to see whether in fact confidence erodes. And if confidence erodes, transaction volumes could fall. Listings have been quite strong recently. That's another point. But again, we might see listings begin to ease. So I think this is an important indicator because, of course, as I often say, everybody, the Treasury, the Reserve Bank, is banking on the housing sector creating wealth, creating incentives for people to actually spend more. But there's so many countervailing forces now that maybe that's not going to work. So I wouldn't be surprised to see prices beginning to fall off. The APRA changes, which basically has allowed the lending tap to open, was a massive mistake. Because what it does mean is that those who can afford to get mortgages and can afford to pay the bigger, because they've got bigger incomes, are actually driving the market higher, but that's leaving a lot of other people stranded. And if the Reserve Bank does cut rates again, as probably they will, as they reach lower bounds, that's just going to have a continued momentum forward in terms of some sectors of the property market. APRA made a mistake, in my view. Well, it probably was a deliberate mistake because they needed to stimulate the market, but it's actually proving to be a really big problem. I think that we've got to see some further intervention in terms of dialing back some of that latitude that the banks have at the moment. Don't think we'll see it, but they should do that. The other point to make is uncertainty. So we know now that rate cuts don't necessarily translate to markets being positive, right? If you think about what's happened with regard to the stock markets over the last couple of weeks, and particularly with the Fed cutting its rates by 50 basis points a couple of days ago, surprise? No, it wasn't surprise. That was expected. We've seen the Reserve Bank cut. People are beginning to wake up to the fact that cutting rates is not a sign of a buoyant economy. It's a sign of problems and issues, right? And that's the key point I want to make, that actually cutting rates is a sign of weakness, it's a sign of concern, and we are running to the point now where we've got to the point where rates are so low that cutting rates hardly has any real impact, firstly. And secondly, it means that the Reserve Bank is going to have to move to quantitative easing. That's going to be a big deal if they start doing that. And all the experience from around the world is that quantitative easing takes you in one direction, doesn't actually support the economy. Look at Europe, look at Japan. And frankly, I think our Reserve Bank is not doing us any favours by taking us down this road. There was a concerted strategy from amongst central bankers to come out and say, we will do whatever we need to do to support the markets, right? What they were really saying was, we will do whatever we need to do to try and support the stock market. So they are thinking about this very, very narrowly. They're trying to keep the stock markets up in bubbly territory where it's been for some little while. It hasn't worked, right? So if you look at the Dow, in fact, the latest data today shows it dropped more than 3% yesterday, and it's been very volatile over the last few days. We're still more than 10% down, which is in correction territory. Could turn into a bear market quite quickly. It's also interesting that people now are saying we can't actually model and take account of all the variables in the system at the moment because we don't know what's happening with regard to the medical issues that are going on. We don't know what's happening with regards to the amount of fiscal support we're going to get. And we know that many companies, because of the supply chain, which are supply side issues rather than demand side issues, mean that we don't actually have any sense of how to value firms. For example, the airline industry came out and said we could see profits down 20%, nearly 190 billion. Simply because of the fall in traffic, right? And that's before we start. So if you look across different industry groups, you'll see that many are actually now beginning to put up profit warnings. Even for locally, we had, the hearing aid guys come out quite recently and say, Cochlear, that their profits are going to be down because of this. We're seeing again and again and again people warning about uncertainty. So you can't take account in the markets of that level of uncertainty, and that's why there's huge volatile movements. And I guess the other point to make is that this has a flow-on effect. So, I'm worried about the banking system, right? Because the banking system is reliant on people with loans making those loan repayments. We've already said that small businesses are now starting to struggle. If some of those small businesses are unable to pay the wages that they need to pay and, in fact, start to have difficulty with their cash flows, that flows on into the household sector, which essentially means that households will then be in difficulty in terms of paying their mortgages. And so it cascades on. So that's the first set of forces. The second set of forces is liquidity, right? So if the international financial markets start to get caught in some of this stuff that's going on at the moment, as I think it's quite likely, a bit like pre the GFC, it was liquidity between banks that started to get into issues where funding's actually got more expensive, not less expensive, despite all the rate cutting. So if we start to see some of that, then effectively we could see that banks being pressurized in terms of liquidity because our banks require support from international financial markets to make their businesses work. We see pressure coming on from households and from businesses unable to pay their mortgages and other loans. And that could start creating a very nasty environment. Stock markets are not going to go up in that environment, but nobody knows how far down, nobody knows how long this is going to go on for. So basically the markets are saying, we don't know, expect huge volatility. Final point on this one, computer trading is such a large part now of the major markets around the world. So if the markets start to move in one direction, that movement is reinforced by massive amounts of computer-generated trading. Ditto if it falls. And so we should expect to see significant up and down movements, so very high volatile movements. And the volatility index in the US is up at 40 again, which is pretty high. And that just shows you that the computer trading systems that we've now got in the interconnected financial markets is creating huge amounts of uncertainty. These markets are not going to settle down anytime soon. My own view is they probably will go lower before they go higher. The Federal Reserve has already put 600 billion more into their coffers, in other words, liquidity, right? And that's through the repo operations and buying treasury bills. They were hoping to taper that down. They won't. They'll have to keep going. We are in a situation now where central banks around the world are going to be forced to put more liquidity in the markets to try and support the stock markets. That's not the real world, though. And that's my concern. So basically, the more that they throw funds at the stock markets, the more the real economy gets crushed, the more that real households get crushed. So this is actually now getting to the point where I think we need to question whether the central bank policies of the last decade plus make any sense at all. And my own view is they probably don't. It's interesting to watch what's happened with gold and even, the cryptos. So there's some interesting questions about what's the relationship between what's happening in the stock market and the bond market and some of the other markets. Just bear in mind that a lot of people who hold gold hold it in terms of derivatives. And so we're seeing a lot of volatility in the derivative markets, and that's having an impact on the gold. I think it's a bit the same in crypto land, although I actually also think that cryptos are a bit disconnected, if you like, from the other markets because of the way that people think about cryptos. But, there is really, my view, no real safe haven anywhere at the moment. So pretty much any asset class, whether you want to look at stocks or bonds or, gold or crypto, there are risks in every market at the moment. The fact that the global container movements are so down, and we also know that now containers are in the wrong place. So refrigerated containers aren't in the right place anymore. So we're finding that that's a significant issue. And remember that it takes, not just a few days, but several weeks to get from one side of the world to the other side of the world on a shipping line. So if you've got containers in the wrong place, and then even if things start to become a little bit better, it's going to take a long time for the flows of trade to start picking up. So again, this is not going to be a V-shaped quick down and quick up in my view. We don't know where the bottom is. We don't know how long this is going to go on for, but I think we've got to assume that this is going to be a long, slow grind. It's going to take a long time to be able to get to anything like right off the back of it. I've tried to take account of all the things that I've been thinking about with regards to the recent movements and other recent medical issues, all those things. My base case is that assuming that this thing really becomes more than just a regional issue, so we're seeing significant global disruption, significant issues with regard to the markets. This could well be the trigger. I always say, as you know, that home prices are ultimately 40% over fundamental values. There's no reason why we wouldn't see that correction start to come in. So over the next couple of years, my expectation is that more likely, 50% likelihood, we're going to see prices down, 30% from the peaks that they were. Now, it may be not like that. There are other scenarios that I could go through, but my base case is now looking pretty worrying. And of course, those people who bought recently, particularly property, when they thought prices were on the way up, this is a classic bull trap in my view, and I suspect a number of those are going to find it very difficult over the next 2 or 3 years. Could be wrong. I'll update the models as more information comes through. There are so many levels of uncertainty at the moment, but that's why I do scenarios. But to me, there is definitely a downside risk to property at the moment. Understand that there's a political line that doesn't want to panic everybody. They don't want to actually, put too much information out too quickly. And in fact, even in the recent Treasury discussions for Senate estimates, they said they don't want to mention too much about how this could play out yet because they don't want to worry the public, right? So there's a real balance there between saying everything's fine, don't worry, just carry on, and trying to actually provide some level of information. Now, clearly there are lots of silly rumours around and lots of panic around. I don't think there's any reason to panic, but I think we need to be a little bit cautious about how this plays out. I think we've got to assume that it is going to get into the general population. We are going to see this definitely quite widespread. And that is why I don't believe this is going to be V-shaped. This is going to be a long, slow grind over a number of months. There are sensible precautions that people could take. I don't think grabbing a lot of loo paper is part of the solution, frankly, but it's interesting. People want to try and get in control in some way, and that's one area that they perhaps can. But I think we need to watch this quite carefully, because the economic fallout and the implications, both in terms of demography and in terms of the health system and in terms of the broader economy, I think are quite uncertain as yet, but lots to watch, I guess, as we go ahead. So there you are, a quick summary about what's going on. Lots of uncertainty. We'll be updating our models and our posts as things develop. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.